So again, much more from global down to local. It's with great pleasure that I'd like to introduce you to Guy Elliffe. Guy is head of corporate governance at ACC, Accident Compensation Corporation, and his topic today is engagement with public market issuers. So I'd like to introduce you to the forum. Thanks very much.
Cool. So we're going from the global and the excitement of E&S to the much more banal G in New Zealand, which is my responsibility. As Craig said, I look after corporate governance for ACC. As you're probably aware, we're the largest New Zealand equity manager. Total assets in the sort of 2.3 or 3.2 billion range. I can't remember which now, sorry, but we're the largest New Zealand fund manager, and I think I'm the only executive in New Zealand with 100% responsibility for managing the relationship between ACC and the boards of directors that we invest in. I guess in contrast with the previous speakers, my emphasis is very much in G, so I'll be talking a lot about governance and not very much about E&S. But I think it's still a pretty relevant subject matter, because in order to look at a wider governance regime, I think it's a good idea to look at the governance that exists today and how we manage it. Just as an initial disclaimer, I am a director of NZX Smart Shares as well, and a member of the investment committee of the Todd Foundation. So good to get those conflicts addressed up front. Now, I just use these arrows. Brilliant. I worked out that I had too many slides, so excuse me for flicking over a few as we go. So always good to start with the definition. So what's corporate governance? The OECD defines it as a system by which business corporations are directed and controlled. I thought NZ Treasury came up with a good insight. This is right back at the time when the mixed ownership models were introduced in New Zealand. The critical role of governance is to provide suppliers of funds with sufficient confidence that the management of the organisation is consistent with the interests of the people who are providing those funds. I condense those together to argue that corporate governance is a set of contractual relationships which provide investors the confidence to commit capital. So that's very much the basis I'm starting with. So I think there's really sort of two parts to that. One is the negotiation of the original terms. When investors commit funds, how is the original dynamics of that contract established? And secondly, what are the ongoing obligations of shareholders and the fiduciaries that represent shareholders to represent their interests in that ongoing contract. I think it's important to emphasise that this is a very important duty. It has direct impacts on the value that shareholders gain from the relationship, and I think if those interests aren't actively represented, there's a financial cost to that. So I'm sure this probably brings back memories of Management 101 to the audience, but essentially there's a three-legged relationship here between shareholders that contribute capital, between management that manage the enterprise, and between the board, which effectively manages the conflicts of interest between the board and between the management and shareholders. The need for that board relationship or board component in that relationship is that there are significant conflicts between management and shareholders, and I think it's important to bear those in mind in any consideration of governance. You know, at the very highest level, the incentive in management is to maximise their own interests and not the ongoing interests of shareholders. We find quite consistently that management's oriented to growing and not oriented towards creating value. And lastly, there's a very naked conflict which exists and that the remuneration of managers is a cost to shareholders. So there's obviously a relationship or a conflict that needs to be managed. So the first point I want to make, this chart looks very simple, but it just disguises two pretty material complications. The first is that chart looks very symmetric. It's not. The essential relationship that exists here is between management and the board. So if I characterise those three arrows, I'd argue that the relationship between the management and the board is sort of a little bit like a steel rope. It's a very close relationship. It's a relationship that's evidenced by day, month by month interaction, by very long-term and strong and close relationships. The relationship between the board and shareholders, I'd sort of characterise as a string, and it's that relationship and how that should be managed, which is sort of the topic of my conversation. And the relationship between shareholders and management is really like a bit of cotton. That effectively, it represents a flow of information from management to shareholders, but in practice, shareholders have no control or power over management. I think it's also important to note that there's a lot of complexity which is disguised in this chart, and this could form the basis of my entire 20-minute address. But just to give you a few teasers why it's complex. First is legal. The legal advisors to corporations will remind you. I guess what I'm arguing here is that the primary responsibility of the board is to represent shareholder interests in the addressing of the conflict between the management and shareholders. So just briefly sort of exploring the complexities. The first is that the Companies Act says nothing about shareholders' interests. The Companies Act defines shareholders' duties in response to their obligation to act in the best interests of companies. So there's a lot of complexity encompassed in that. When we're talking about the maximisation of shareholder interests, what do we mean by shareholders? Shareholders aren't a homogenous group. They've got different objectives, different risk tolerances, and different influences. Some of them are close to directors, and some of them aren't. Now, thirdly, what does interest mean? And especially for a listed company, for a formed company, companies can basically define the interests, or shareholders can define the interests. But in the listed company space, it's a lot less clear. I'd argue that interests are basically defined as the maximisation of total shareholder returns over time, but there's a lot of complexity in that enunciation. But for those of you that are sort of familiar with the literature, we're on the edge of a discussion of shareholder primacy and director primacy. What is the major obligation of the board? And it's an incredibly important and complex area, which has got increasing implications as we increase the complexity of governance, going from the governance of this relationship to some of the complexities that arise from the matters that have been discussed this morning. I guess the first point I'd make is that this stuff's important. The way that boards exercise their responsibilities have material impacts on the TSRs, on the value that shareholders get from relationships. And in addition to that, it has material impacts on the non-financial outputs of the business, which was sort of hinted at this morning. So there's a set of material direct relationships. There's a less obvious and less direct relationship I'd like to reflect on too, and it's what I call the societal contract. You know, the reality is that shareholders and these contracts don't exist in a vacuum. They're effectively a contract which is countenanced by society. The whole limited liability structure depends on the legal structure providing outcomes which are acceptable to society and the economy in general. So I'd also like to ask you to reflect on this societal contract. Sort of interesting. It's not a big area of focus in New Zealand, but I'm sure you'll remember the GFC in the US and the billions of dollars that were destroyed by effectively poor director decisions at companies like Enron and WorldCom. Sort of interesting to reflect on, who bore the responsibility for that value destruction. And the final analysis, it wasn't those directors that bore the responsibility; it was the shareholders that appointed them. There's a deep responsibility for shareholders to make good decisions about governance because it has huge impacts on society in general. So I'd like to move a little bit from the theoretical a little bit more to the practical. So what do we mean by engagement? And there was Peter on the previous slide gave some good examples in the international context. In New Zealand, at the first level, and I guess I'm talking about my day-to-day job here, it's the ability to assess the strategy of the issuer and the ability of the issuer to execute on that strategy. So our obligation is to basically make the judgment about whether that strategy is appropriate and whether it's being executed. So there's a research component. Secondly, there's an engagement component. Again, an analogy with the previous presentation. We meet with virtually all the major issuers, with the chairs of all the major issuers that we invest in, pretty much on an annual basis. The argument or the rationale for that is one, to communicate our insights, and two, to establish a relationship that can explore going forward. Thirdly, there's annual meetings, and again, analogy. The annual meetings consist of a set of resolutions that shareholders vote on. Those resolutions are important, and part of my role is to advise our portfolio managers about how we should vote on those resolutions. So yeah, essentially the argument here is that these resolutions have got very important implications. I think most important is the appointment of directors. Nothing's more important to the governance of an issuer as ensuring the right directors are on the board, and that the intellectual skill set that the board has, the board matrix, is adequate to execute the strategy. Secondly, approval of major transactions, which are, as it sounds, transactions that are large, and related party transactions, which are transactions between related parties, obviously. It's a critical aspect. Thirdly, from time to time, companies change constitutions. That influences the balance of rights between shareholders and management. So they're important. At the end of companies' lives, the schemes of arrangement that might reflect the sale of the business to another business. And lastly, probably the most direct conflict, but probably the least important, it's the obligation of shareholders to approve directors' remuneration. So it's probably pretty obvious, but I think it's worthwhile exploring a little bit. But there's some pretty obvious tensions involved in in the exercise of those shareholder rights. It inevitably involves the small fragmented investors. Even ACC is the largest investor in the New Zealand market, typically only owns, say, between 1% and 5% of the issuer. So it's a very fragmented democracy to draw that analogy. And secondly, we're holding some pretty powerful people to account. The people that are the directors of these major issuers are New Zealand's most powerful businessmen in many cases. And there's a tension involved in small fragmented holders holding powerful, wealthy individuals to account, how do we do that? I think the most important aspect of it is being well prepared, sort of understanding, defining a joint objective, a joint alignment, and using that as the basis for the discussion. Secondly, is sort of Anne Marie's in the room, New Zealand Super. I think the relationship between shareholders is a very critical aspect of bringing a greater level of power. I guess I understand that's probably the interest of the room is your fiduciaries who have responsibility for managing assets, and I think I'd make the same argument that it's important to join together to preserve and maximise the value of shareholder rights. And thirdly, and it's a sort of lead into this slide, as active participants in the market, we have the ability to effectively regulate the settings, and that's a very important part of my role. It's a role that's both very interesting, and there's a tremendous amount of activity going on at the moment in that area. The lesser part of the work is the relationship with the government. Basically, an argument for ensuring that the laws are crafted to enable shareholders to protect their rights. There's two bits of legislation that are currently under consideration. There's a bill sort of impacting director duties, which are private members' bill, and there's some pretty active discussions about the major transactions component of the Companies Act. Probably won't go anywhere, but the bottom line is that there's easy ways for directors to circumvent the provisions in the Act, which are intended to protect shareholders against directors conducting major transactions, which they don't judge to be in their benefit. The vast majority of work is with respect to the NZX rules and the NZX code and the guidance notes. This is probably getting a little bit technical, but this is the guts of where the contractual details are nailed out. Currently, there's a code review going on, which is basically a description of the relationship. There's a review of capital raising going on. The basic issue here is what forms of capital raising are fair for existing shareholders. The shareholder right, which is implicit, is that we'd argue that existing shareholders have a right to participate in capital raisings and to bear and to get reward if there's any of those rights are lost. There's a formal yesterday there was a guidance note related to major and related party transactions, and that's currently underway. Probably one of the big things is there's a review of what director independence means, which the NZX is creating, which is conducting early in the next quarter. I guess of the complications I discussed in my discussion of the contract weren't enough. There's two other major complications here. One I've sort of hinted at is fragmentation. how do a number of fragmented shareholders exercise their rights? It's a material challenge. The thing that should make it a little bit easier is that those individual shareholders have actually got pretty aligned interests, and more than that, in the vast majority of cases, it would seem to be in the interests of those shareholders to communicate and exchange intellectual capital. It doesn't happen very effectively in the New Zealand market. Institutions do it well between themselves. With NZ Super and ACC, we've got a good relationship. We've got strong relationship with other New Zealand investors. New Zealand Shareholders Association does some good work in this category, but I would raise that as a potential gain for people like yourselves who are effectively making fiduciary decisions on behalf of the funds that you manage and the wider community. Okay, I've run out of time, as I've accepted I would. I guess in terms of final comments, and a bit of summary, if you like, shareholders are in a difficult position representing their rights. It's a challenge. We've got to do it actively. It's important we do it actively. And I guess my argument to this group is let's work together to enforce those rights. Secondly, it's not enough to leave these decisions to directors, as happened in the US in the GFC. It's just, I think it's morally and ethically unacceptable for shareholders to not hold directors to account in the decisions they make. So I think we've got an ethical and legal right to enforce those accountabilities on directors. Shareholders have got to do it. Nobody else is going to. Nobody else is holding directors accountable. And thirdly, that the complexity that the E&S part of the ESG triangle brings sort of significantly increases the complexity of this governance equation. And I think let's get the basics right in terms of the G part before we add on too much complexity in terms of the E and the S. So sorry, I've probably gone on too long. My time for one quick question or not?
Oh, no, it may not be. Just a declaration of interest. I've been on the end of Guy's probing as chairman of Precinct Properties and chairman of New Zealand Wind Farms, and I can assure you he does a very good job and does ask the right questions and puts us on the spot. So I'm just a little bit surprised at the paucity, the smallness of the group that Guy works with in New Zealand, and maybe there's an opportunity for other foundations, community based investment committees to work more closely together if they are direct investors, for example, try and lift the ability of the investment community to hold directors to account. It's very, very important for the companies, but for our society. So thank you. But there may be some questions, I'm sure, from the floor. Are there any questions for Guy?
Thanks for the correction.
No.